The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, everybody. Ron Wheeler here. Welcome to our efficient option buyer class. I'm just kind of readjusting my screens here, and I always like to start the class a little bit early just to make sure all the audio is working and everything's working properly. I think the screen is shared. I do have a little bit of an issue over here with some audio on my side. I'm going to have to fix that real quick, so bear with me just a second. You guys are probably hearing the audio okay, but the I'm streaming and they are not. So let's take a look here. I don't think it's working. So let's go ahead and try that. All right, so this is why I always start a little bit early because it helps me clear up any issues that I might have.
Hey Ron, it looks like it's streaming on YouTube.
Is it streaming on YouTube okay?
I can I can hear your voice, and it looks like it's on.
Okay. All right.
That's just in case you guys out there listening have sound issues. You can pop over to YouTube and watch it there. But GoToWebinar is great for us to interact back and forth.
Okay, cool. Yeah, now I know for a fact 100% it's working because I was looking at my streaming software and it wasn't looking like it was working good. So, all right, now I am 100% convinced that it's working right. Welcome everybody again to the Efficient Option Buyer, and that is why I start the class a few minutes early, just in case I have any issues like that. Now, for those of you that are with me on the webinar from GoToWebinar, if you have never been in a GoToWebinar format before, this is how we interact. There is a little toolbar, has a little orange arrow on it right here. If you click that, if it's not already open, that'll open up kind of like your control panel. And under the little questions box, this is where you can type in questions for us during the course. Now, if you have any questions, feel free to ask. We'll have a Q&A session at the end for more formal questions, but I've got my colleagues here, Brian and John, and they're going to help with questions during the class as well. So feel free to go ahead and let me do this. Just so I know that everything's working, give me a shout out in the question box. Let me know where you're from. Randy, you were first. You were mentioning that you're from Edmonton. Welcome. And I see Todd and Kelly and Larry and Tim from Canada. Wow, a lot of Canadians. John, Nova Scotia. Massachusetts, Sandy, welcome. Lawrence from California. New Jersey, Rob, welcome. Miami, it looks like John. They're flying by now, so it's always hard for me to kind of keep up on all of them. So if I miss you, I apologize. Richard from Toronto and Randall from San Francisco. North Carolina, Jim, welcome. Ashok, you're from Philadelphia. Michael from Arizona. Dale from Missouri. And by the way, I and my staff are the only ones that can read this. Steve, welcome. McAllen, Texas. Fort Benning, Thomas, home of the infantry. Spent a lot of time down there, not personally, but my brother, but visiting him when he was stationed at Fort Benning. Houston, welcome, Elder. Gil, Toronto, welcome. Harry, also from Canada, Ontario, welcome to you as well. Texas, Carlos, welcome. Perth, Australia, welcome. Denny, welcome from Cleveland. I'm actually in Medina, just south of you, so we are close. In case you didn't know this, VectorVest has two offices. We have one in North Carolina outside of Charlotte and one in Akron, Ohio, and I work for our Akron office. Mike from Omaha, welcome, and Norma from Lakeland, Florida, welcome to you as well. Deepak, welcome, North Carolina, and Carter, also from North Carolina, welcome to you, and Murray from Ontario. Well, I'll tell you what, it is now 6 o'clock Eastern Time, right on the nose. Let's do this. Let's go ahead and launch into what we're all here for today, and that is to learn how to be an efficient option buyer. Now, my name again is Ron Wheeler, and my official title here at VectorVest is I'm the manager of options trading. I'm also what I like to think of as an options income coach. What I do is I teach option trades that are based on probability, and you're going to see how that works through this course today. What I do is I place option trades that give me a better than 50% chance of making money. And it's not because I'm an astute technical analysis or I can read the market better than anybody else. I build trades that make that happen. And the way that I got there is I've been trading now for 23 years, so a long time. When I first started trading, I was a day trader, very quick, in and out in 30, 40 minutes. I did swing trading. I traded a lot of futures and commodities. Well, when I started teaching this, I started teaching technical analysis. I taught things like Elliott wave and Gann and Fibonacci and all that kind of stuff, and stochastic and MACDs and oscillators and all that cool stuff, right? Well, over the course of the years, I met a client who actually was a hedge fund trader, and he was using the analysis that we taught him for his hedge fund. And he came to our office because he was in town. He's like, hey, Ron, I just want to show you what we do with the hedge fund using options. And he kind of introduced me to the idea of using options with our analysis to create situations where even if the analysis was wrong, he could still make money. Now, I didn't really just switch to options after that. I was doing very well as a trader of equities and futures and things like that, so I stayed with what I did. And then right around 2000, I'm going to say 2010, I started thinking about, okay, I don't want to be sitting in front of my computer for the rest of my life. I want to start trading things that are a little bit more casual. I don't have to watch the computer all day long. And I remembered the option stuff that we did. So over the couple of years there, I started transitioning and doing more option trades until about 2012. Then I just started doing pretty much 95% options. So to this day, I stopped day trading for the most part. Now I'm just an options trader. And what I'm going to show you today is a good part of what I do. Okay? So the goal here is to show you how to become an efficient option buyer. Now, when we talk about what is an efficient option buyer, well, I'm going to show you that through the rest of the presentation today. But to start, I want to show you who's not an efficient option buyer. What or who is not an efficient option buyer? So let's start with a recent example. This is IBM. Now, IBM has a really good looking graph, and you might disagree and say, Ron, that doesn't look all that good for buying. But you got to think of what the market was. This was in April. The market had that big sell-off after the coronavirus thing hit. The market bottomed in March, and then it started rallying. This is where we are right now, when the market's been rallying since here. Now, option traders. What does an option trader do in this scenario? Most option traders would simply buy a call. They would go out maybe 45 days. They'd buy an option that's at the money or slightly in the money, and they would go out there and buy a call. Why? Because a call gives you the right to own the stock. If I go out there and buy a June 19th, 2020, that happens to expire this Friday, by the way. This was back in April when I took the screenshot. And let's say I did it at 125. This gives me the right, but not the obligation to own IBM. So if IBM goes from 128 to 140, at any time I want to, I can execute my right to own the stock. The stock can be at 150, and I can buy the stock for 125 and make a lot of money. Now, most option traders, by the way, don't do that. Most option traders do not take stock. We trade options because it is a very inexpensive way to control stock. That's all. So in most option traders, what they will do is they'll buy this thing. The stock's at 128. They'll buy a 125 call. The stock goes to 150. The price of their call goes up. Maybe they buy it for $5. Now it's trading at $10. They just go out there and sell the option to someone else. They'll exit the option trade without ever owning the stock. Now, the problem with doing that is most of the time, the stock doesn't move enough or it doesn't go in your favor quick enough to make money. So if we would have done that trade and we would have bought into this with a call, this is how the trade ultimately would have worked out up until today. In almost 2 months of you owning that call, even though the stock went down, but then it started going up after that into May, even though the stock started going your direction, you were still at a loss for basically 95% of the time you held that option. Now, you can look at this and say, "What, Ron, come on, I would have gotten out right here when it was actually profitable." Okay, maybe you would have. You're probably one of the 1% of traders that would recognize that and get out of it. Most traders wouldn't, because what would happen is they'd be like, all right, this market's going to continue going up and I'm in good shape. And then 1-2 days later, guess what? You're back into the loss column again. 95% of that time, that trade was a loser. Okay? It was a loser. Now, ultimately, why does this happen? Well, there could be multiple reasons. Maybe the stock wasn't a good stock after all. That happens to all of us. We don't buy the right stocks or we don't take the right trades. But the biggest reason why this occurs is because as an option buyer, probability is really not on your side. You have to be careful here. This is an example of Apple, and I took this screen capture actually today. Okay? Apple at some point today was $354.06. All right? Now, in order for you to make money on this trade in August when this option expires, Apple has to actually be above $374. Now, a couple things work against you as an option buyer. The biggest thing is what's called time decay. What happens is when you buy an option, every day that you get closer to the expiration, that option loses value. Even if the stock goes in your direction, if you buy a call and it goes up, or if you buy a put and it goes down, every day that option disintegrates in value. Okay? So as you're going up, the price of the option could be going down. It's really putting you at a disadvantage. By the time this option expires, if Apple didn't go up $20 a share, you're not going to be profitable. Ultimately, that means that even if you're right on direction, you may not make money on the trade. That is the most frustrating thing as an options trader. One of the most frustrating things as an option trader, to be right on the trade and then still not make money. That is an example of an inefficient buyer of an option. So again, let's transition. What is an efficient option buyer? Well, an efficient option buyer, what they do is they use what's called spreads to increase their probability of making money. Okay? What we are going to do is we are going to do a spread trade. We're still going to be a primary buyer, but then we are going to sell an option as well. And as an option buyer, these spreads are very low level. Most people can do these in their option and brokerage accounts. They're very, very easy trades to master. Now, at the same time, you're also reducing trade costs by quite a bit, and you're increasing the rate of return. So you're spending less money, less risk, and you're making more money on your capital. So today, here's what we're going to do. I'm going to kind of transition into showing you, the first two trades I'm going to show you are how to be profitable even if you're wrong on direction. Okay? I'm going to show you trades that will reduce the capital that you need. You're going to be able to trade these really expensive stocks with only a couple $1,000. Then I'm going to show you how to profit from earnings announcements. I'm going to show you a really good trade that works in the earnings window. Then the last thing I'm going to do is I'm going to show you how a spread can help you buy inexpensive portfolio insurance. So what does that mean? Let's say you have a $100,000 account that you're buying a lot of stocks on that pay good dividends and they're good growth stocks and all that kind of stuff, but you're worried about a market turndown. I'm going to show you a spread trade that you can use that actually gives you very, very good protection, and it usually costs about 50% of what a normal hedge would cost. It's a really cheap, inexpensive, effective way to hedge your capital. All right? Now, at the end of the course, or at the end of this presentation tonight, I'll discuss an opportunity that we put together that's going to help you learn the things I show you today in a step-by-step manner with my help. Okay? So do me a favor. If that sounds all good to you, shout out in the chat window, give me an okay, and then we will get started officially. All right, good deal. Well, let's do the first thing I talked about. What we need to do is learn how to win even if you're wrong. Okay? We need to learn how to win even if you're wrong. So if you're bullish on a market or a stock, using Disney as an example. Now, this was an example from Disney from like 2016, right? It honestly doesn't matter when this trade happened. It really, really doesn't. Okay? But you have to learn from the past and set up trades in the past to know how to work with current results or current markets, right? So Disney back in 2016 and early 2017 was a great looking trend. We naturally want to take part in this, right? We want to be buyers. Well, the first thing that you can do, I mean, this is basic. We can buy the stock, right? Well, we can go out there and buy 1,000 shares of Disney, and it's going to cost us about $108,000. Now, okay, Ron, that's a lot of money. All right, we'll buy 100 shares of Disney. It's going to cost you $10,000. Even so, it's going to cost you a lot of money to simply buy stock. All right? Now, The problem, of course, with that is not only does it cost you a lot, it's basically a zero-sum game. And I'm using zero-sum game with a little bit of liberty there. It's basically a zero-sum game. If the stock does not go up, you will not make money. Okay? If the stock goes down, you will lose. Now, what we could also do, like I just told you, as an inefficient option buyer, we can trade the options. For a bullish market, we can simply buy a call. Well, if I wanted to do a trade that was similar to 1,000 shares, I would buy 10 call contracts. Why? Because one call contract controls 100 shares. So if I wanted to control 1,000 shares, I would buy 10 calls. Now, the cool part about this is, and there's a couple of cool parts. The first thing is it only costs you $4,900. That's like 5% of buying 1,000 shares. It costs you a lot less. But there's still a problem. The problems with buying the shares, again, it's a zero-sum game. If the stock doesn't go up, you don't win. Okay? You also have no built-in protection. What happens if Disney has a bad earnings announcement, or if there's some sort of fraud or some sort of weird thing, like, who knows? What's the worst thing that could happen to Disney? Now, this would never happen. What happens if there's some kind of pandemic and Disney can't open their theme parks, right? That could never happen. Well, I'm being a little bit sarcastic there because it did, but things like that. So if Disney one day opens up and now it's at $100 a share, you just lost $8 and there's no protection against that. Now, when you go into the options world and you buy a call, well, a couple things happen here. Number one, we already talked about this. Buying a call, I like to think, puts you in a bigger hole. Because when you buy a call, remember, if the stock stays completely sideways, you will not break even, you will actually lose money. So in order for you to actually make money by this time this option expires, we have to rise up above $110 a share. So we have to go up at least $1.70 or $1.60 to make money on this thing at expiration. All right? Now, on a positive note, you do have a limited loss here. If you buy 10 contracts at 105 of Disney and the stock opens up at $50 for some reason, well, your loss is only $4,900. That option will expire worthless. The right that you had to buy that Disney will just disappear. You don't have to take it. And you walk away drawing down only $4,900. It's not the end of the world. Now, what I want to do, I want to put together an options trade that if the stock stays right where it is over the course of that option's life, we can make money. I want to put together a trade that even if the stock, let's say, goes down to 104, I can still be profitable on the trade. Essentially, what I want to do is trade with a cushion to be wrong. The stock's at 108. As long as it stays above 105, I can make money. Now, most investors are familiar with this. They're familiar with the concept of what's called adding a cushion, but you just may not understand that you know it. So let me explain how this works. Let's go back to the basics. If we buy 100 shares, 1,000 shares, or whatever at Disney, we're going to pay $108.38. One of the most basic option trades out there is basically called a covered call. We can go out there and sell a call against our stock holding and basically create a cushion. If I sell a 111 call for $1.47, remember, I own the stock for $108.38. If I sell a call for $1.47, I'm going to reduce the break-even price down by $1.47. As long as the stock stays above 106.91, now I am profitable with Disney. That trade, again, is called a covered call. And honestly, everybody that's a stock trader should realistically be doing covered calls. It's a very, very good trade. And what you can see here now I realize that not everybody is going to be familiar with how to read a risk graph, right? This is a risk graph for an option position. And what this blue line, this dark blue line right here, what that says is on the day the option expires, February 10th, how much money I will make or lose. So I want you to follow visually that solid, don't worry about the dash line, not important right now. Follow that solid blue line. If on February 10th, Disney is trading at $110, I will make about $2,700 on that trade. That's where that solid line is. Now, on February 10th, if Disney rallies to 112, I would make the full profit of about $4,090. If Disney stays right where it is right now, I would probably make about $1,500. If Disney, on the day that that option expires, February 10th, trades down to here, which is about probably 107, or yeah, it's pretty much right at 107, I would break even on the trade. Anything lower than that, and I would be losing money. That's the idea of a covered call. I've created a position that even if the stock goes sideways, I can be profitable. I'm adding probability. Now, the covered call is great, Ron. Should we just stop here? If you want to. But here's the problem with the covered call. The trade's still very, very expensive. Okay? It's going to cost you $107,000 to place this trade, not including any, any margin that you might use. All right? So how do we do this exact same concept but make it cheaper? Instead of buying the stock, what we can do is use the power of option leverage to reduce our costs. We're going to do this trade with less upfront money and increase our rate of return. And how we're going to do it? We're going to replace the stock with a call. Now, brokers allow you to do this. I can buy a call, which gives me the right to own a stock, and then I can sell an option against it, just like you can do with the covered call. So instead of buying Disney at $108, what I'll do is I'll go out there and buy a slightly in the money call. Okay? Disney is at 108. I will buy a call that's a little bit in the money. So that basically means a call that's below the current price of the stock. This one right here at 105 works like a champ. And I usually use about 45 days to expiration as my minimum. Sometimes I go past that, but I usually use about that as a minimum. Now, by buying that 105 call alone, remember, I've reduced my cost to trade this by 95%. 1,000 shares is going to cost me $108,000. By buying those calls, I can do it for $5,570. Now, we're going to perform basically the exact same thing that we did with the stock. I can go out there, sell that same call. I buy or I sell a call against my long call. And what you're going to notice is I use different expirations. I'm buying an option in March, and then I'm selling an option in February. Okay? Now, what that creates is something called a bull call diagonal trade. And what you'll notice is it's very, very similar to a covered call. Okay? If the stock stays completely sideways, I can be profitable. If the stock goes higher and higher and higher, I can be more profitable. If the stock goes down, I still, of course, would take a loss, don't get me wrong. But now what I've done is I've reduced my trade cost and I've boosted my rate of return. Here's how. The maximum profit on this trade is lower than the covered call. Okay? I want you again to try to look at these solid lines. This orange line right here is the covered call trade. My maximum profit that I can make is about $4,000. My maximum profit that I can make on the diagonal trade is about $2,500. Okay? Now, take a look at the risk. On the covered call, my maximum risk is about $106,000. On the diagonal, it's only about $4,000. Now, I will tell you this, you're not going to lose $4,000 on that trade. And I'll explain it a little bit more. I've got a more real-time example of this that I set up today on Apple, where I'll show you kind of how it works a little bit more. Now, the cost of the trade obviously is a lot lower too. Instead of doing that covered call for $106,000, this trade only cost me $4,000 to place. Okay? Now, I also want you to consider what would happen if we were to make the maximum on this trade. Well, if I have a trade out there that costs me $4,100 and I pull in the maximum profit of $2,500, I have just returned a 60% rate of return. If I do $106,000 on the covered call and I make the full $4,000, that's about a 4% rate of return. So you've reduced your trade cost dramatically, and you've boosted your rate of return. Another thing that you'll see, by the way, is if there's like a really big disaster in the market, let's say the stock opens up at $100 a share. Well, with that covered call, you might be down about $10,000 in that position, whereas with the diagonal, you're only down about $3,000. Now, obviously, we would never want that to happen, but again, it does have disaster insurance kind of built into the trade, where it's going to limit your loss. And again, that still gives you the cushion of a covered call. Lower cost, higher rate of return, and it still adds probability to the spread. This is one of my favorite trades. You can reduce cost. You can increase your probability to over 60%. This is what I call, well, it's called a bull call diagonal trade, but it's also called a synthetic or a poor man's covered call. It's basically the same thing, but it costs you a lot less. Anybody can do this trade, and it boosts your rate of return. So let me give you guys another example. This is a trade that I put together today on Apple. Apple was about $353. Okay, I'm going to give you the basic semantics of how I do this trade. I typically will buy an option at least 45 days to expiration. Right there is an August 21st Apple call. I usually buy the call right below the current price of the market, sometimes a little bit deeper. All right, that's going to cost me $22. Then what I typically do is I will sell a call that expires the month prior to when I bought the call. So I bought in August, I sell in July. And then typically what I do is, and this is kind of where there's a little bit of a rule base for this, I try to buy an option that has anywhere from about a third, or sell an option that has about a 35 to 50 delta, but you have to kind of work it on the risk graph to see what you like. Okay. Another thing that I can do a lot of times is I can sell an option that's about 22, and I can buy one that's usually about half or a third of the price as well. So, or sell one that's about a third of the price. There's a couple different ways to do it. But I want you to take a look at how this trade works. Now, when I do this trade would cost me $985. Okay? I look to take profits. What I do is I go up there and say, all right, what is the maximum profit that I could make? If my maximum profit is $1,000, I would look to take profits at 1/3 that price. That basically means as long as the trade goes up about $300 a trade, $300, I will make money. So right about here, 1/3. And if you want, you might want to ask, Ron, where's that 1/3 come from? That comes from experience, and that comes from backtesting. That is the most optimal and efficient way to make money here. Don't be greedy. Don't think you're going to make $2,500 because you're not. That means that the trade on expiration day has to be right at 355. That's not going to happen. Okay? That's like playing roulette and betting it on, 28 black or whatever. Okay? Chances are you're not going to hit that number. So instead what you do is you just say, bet all the black numbers or all the red numbers. It's kind of the same idea. All right? We're looking to make about 1/3 of what the maximum potential profit is. Now, what this means, if you look at that solid line again, that is my profit on the day this trade expires. So, if the trade expires and the price of the stock is $340 a share, you will make your $300. Think about that. Apple's $353. If it goes down $13 a share, you will still walk away from that trade at full profits. Now, what's the downside? Well, here's the downside. If the trade goes up too much, you might not make $300 on this trade. Oh, you'll still be profitable, don't get me wrong, but you might not make quite as much. Because what ends up happening is this trade, and I'm going to throw this word out there a lot today, efficiency. This trade loses its efficiency if Apple goes up too much. So if Apple goes up over around $378, and by the way, where I'm getting that number from, I'm looking at my risk graph. This right here is where my profit objective is. Anything lower than that, and I won't make the profit I wanted. anything higher than about right here, and I won't make the profit I wanted to. So if Apple goes up to $375 a share in the next week, instead of making $300, I might only make $100 or $150. Okay, that is the downside of a synthetic or a bull call diagonal trade. The market can go up too much and you won't make as much. Think about that, right? That's a good thing. Oh man, the market just went up so high, I only made this. All right. Now, if that happens, don't fret. You just exit the trade, take your smaller profits, and do a brand new trade. It's beautiful, right? Don't pout. Just do a brand new trade. It's great. Now, what is the actual risk on this trade? There's a couple different ways that I teach risk management. One of the more aggressive ways that I teach risk management is if the trade falls below the break even at expiration any time during the trade. Now, what does that mean? This blue line is my expiration. This right here is what I call the break-even point. Why? Because that's where, if the stock goes down at expiration, you would actually lose money on the trade. So that right there is where I would place my stop on Apple. You're not just going to buy this trade and walk away and do nothing. Okay? You're going to place a stop on this trade, no different than if I went out there and bought 100 shares of Apple. So what I do is I look at the risk graph and say, all right, there's my break-even point. That's where at expiration I would no longer make money, and that's my stop. That's a stop around $335 a share. Now, your enemy is this. What happens if you get into this Apple trade, right, and in 3 or 4 days you're wrong and Apple goes down, that $20 a share? Well, you're going to lose money. You're going to lose on this trade probably about $125. Okay? So you have a $125 risk because that's where you'll get out. But Ron, what if the market gaps? Okay, instead of losing $125, maybe the market gaps to $330 and you lose $175. It's still not going to hurt you very much. And that's in the case of a gap, right? You're already playing with a lot of room to begin with. Now, this trade has around a $300 potential profit. So you have a $125 risk, a $300 potential profit, and really as long as the stock stays above about $340 a share, you will be profitable on this trade. That is why I love this trade so much. It really is a great way to increase your probability. And if you were to make $300 on this trade, you're going to make 30% of your money. You're going to have a 30% ROI. Even if you make $100, you're still going to have a 10% ROI on this trade. That's the beauty. And you can do this trade with $985 in your account. It's a very inexpensive way to trade a very expensive stock. So essentially what you're doing is you're trading like this. You're trading Apple, giving yourself all of this room to be profitable. If the stock falls down below 340, you're going to take a loss on the trade. It's okay. But you're giving that trade $13 of buffer or cushion, as we like to say. Okay? That is the beautiful thing about that trade. All right? Now, again, that's my favorite trade. That is my favorite efficient option buying trade. Now, you can do that in bullish markets. You can also do it in bearish markets, FYI. So I can do what's called a bear put diagonal if the stocks are moving down. So we can do it in both directions. Now, what I want to introduce to you is my second favorite efficient option buying trade. We're going to use the same kind of concept to trade with earnings. So we can use a similar spread where we're buying an option farther out in time, we're selling something closer. We're going to use that same concept to take advantage of an earnings announcement. Now, this trade is called a diagonal or it's called a calendar trade. And what we're doing is we're taking advantage of the rise in implied volatility as earnings approaches. Okay? So this is a graph of IBM. Now, in this, okay, one of the most predictable things in trading is how implied volatility moves when earnings come out. Okay. Now, if you didn't know, what is implied volatility? Implied volatility, very simply put, is the percentage. Now, I'm giving you a very loose definition of it here. Okay. Implied volatility is essentially the percentage of what traders think the stock will move in the future. So, if implied volatility is 10%, that means that traders think that IBM has a chance to move 10% in the future. How much in the future? Well, it depends where your option expires. Well, what happens is that number will increase as we get closer and closer to an earnings announcement. If it's 10% 3 weeks from earnings, it'll probably be 20% when you get right up to the earnings announcement. Now, what you're looking at right here is an indicator that charts this. What this indicator does is it charts the rise in volatility. Now, these little sections right here where it says E, that's an earnings date. So what you see is volatility rises dramatically to the earnings date and then falls immediately. Rises to the earnings date, falls immediately. Rises to the earnings date, falls immediately. Doesn't have much of a rise here, but it still rose, falls immediately. Rises, falls dramatically. Rises, falls dramatically. Okay? This is like clockwork. Now, what I want to show you real quick is I want to show you what happens. All right? Now, I'm going to go ahead and use an example of Apple. All right? Give me a second here. Now, I want to show you how volatility affects an option premium. Right now, if I were to go out there and buy a $3.50 call on Apple, it's going to cost me $13.80. All right? Now, I want you to look at this dashed line. This is what my profit would be if Apple goes up. So if Apple goes up to $355 a share, now the market's closed, so that would be, today. If Apple would have went up 300 to 355, my trade would make $186. Okay? The price of my option would increase from $13.80 to, what is that, 186? It's like almost $2. It would go up to like $15 and we'll call it 50 cents. Okay? Around $15.50 is what that premium would go to. Now, volatility affects how options are priced. The higher the volatility, the higher the option premium costs. The lower the volatility, the lower the option premium costs. Okay? Now, I'm going to add a second line, a dotted line to this risk graph. Now, what I'm going to do is I am going to show you the effects of volatility. If volatility on Apple goes up by 10%, okay, 10%, this is what the option would do. If volatility goes up on Apple by 10% and the stock doesn't do anything, your option that was worth $13.80 is now basically worth about $17.80. The price of that option increased by $4 because option volatility went up. It's a very powerful thing as an option buyer to get that volatility working in your favor. Now, unfortunately, if volatility goes down, let's say it goes down 10%, well, as an option buyer, guess what? Now your option that was worth $13 is probably now only worth about $9. Okay? So volatility affects how much that option costs. All right? Now, what we're going to do is we're going to time a trade to try to take advantage of that clockwork implied volatility move. Generally speaking, the increase in volatility happens around 3 to 5 weeks before an earnings date. Okay? Now, that rise in volatility that I just showed you creates a fantastic trading opportunity that's very high probability. It's very, very inexpensive. This is what we call a calendar spread. Very, very similar to the diagonal spread. The difference is the calendar spread uses the same strike prices. I'll show that in a minute here. Now, in my opinion, a calendar spread typically is kind of not a great trade. It's not something I would typically do. Here's why. This is a calendar spread. Okay, if I placed a calendar spread on IBM, if I just went out there and I bought a November 15th option, I sold the month prior, I used the same strike prices, this is what a calendar spread would look like. The only way you're going to make money on this is if IBM over the next 31 days stays between 140, we'll call it 143.50, and down here to about 137.40. That's it. The stock basically has to stay in a $4 range for you to be profitable. All right? This is not a great trade. Let me show you how to take this not great trade and turn it into a killer trade. What we're going to do, instead of just going out there and selling a month option and buying 1 month out there further, we're going to steer the expiration to an earnings announcement. Because remember, earnings announcements boost implied volatility. So what I do, and this is something, by the way, that I do only on stocks that have weekly options. Very, very rarely can you do this with a stock that does not have weekly options. Weeklies are very, very critical. Okay? What I'm going to do, I am going to buy the October 18th, 2019 option. Why? Because that's when the earnings announcement happens. It's September 17th. It's a month before the earnings announcement. I am going to buy an option that expires the week of earnings. Then what I'm going to do is I am going to sell an option the week prior. It's called a call or a put calendar spread. You can do it with calls or puts. It really doesn't make much of a difference. Okay? Now, what happens? What happens is because that implied volatility is going to go up so much, guess what? Now your break evens and the chance of you making money, look at what happens. Now you have a break even at $153 a share and a break even low to about $127.50. Now if the market stays in this huge range, we can profit from this opportunity. And the cool part about that trade is it only cost you $142. Now, earlier I talked about how you would take profits at 1/3 of the hypothetical max profit. Well, this trade right here has a hypothetical max profit of about $400. I would take profits on this trade of what? What's 1/3 of 400? About $133? I would take profits at about $133 on this trade. That's basically almost a 100% ROI. The risk is extremely low because we would exit the trade if we cross the break-even prices, and your risk is extremely low. In my real-life trading, just to give you guys an idea, my average gain on one of these trades is about $400, and my average loss is about $125 to $150. Okay? With a pretty good probability. Hell, even if you're 50% right, when you're making $400 and you're only losing $150, you could be 50% right, and you're still making a good amount of money. That's the beauty of this. You're being efficient. You're giving yourself a greater chance to make money. Okay? That's my second favorite debit spread, or what I call efficient buying. Now, to wrap this up, my third and kind of like my final trade that I want to show you tonight. I want to show you an offset of what's called a bear put trade or a bull call trade. Now, the nice thing about a bull call or a bear put trade, it's a cheaper way of doing a directional trade. Now, those trades don't give you probability. All right? Let me explain how this works. Apple. We talked about this, right? If I just go out there and buy a July 17th $350 call on Apple, it's going to cost me $13. The break even on this trade is $363.80. Well, a very simple spread that you can do is something called a bull call. Not a bull call diagonal, but a bull call. A bull call diagonal, which you guys learned originally, that was the synthetic covered call. You're going to be buying a call in 1 month and then selling a call in a month before that. A bull call trade is using the same expiration. We are going to buy an at-the-money call, then we are going to sell the same expiration, and we are going to sell an out-of-the-money call. So 350 is right where the market is right now. 365 is a little bit out there. That is what you call a bull call spread. Now, what's the advantage of this trade? Well, there's a couple advantages. Number one, you reduce the trade cost by quite a bit. Instead of being a $1,300 trade, now you only have a $692 trade. Instead of having a $1,300 max risk, you only are risking $692. The second thing that's nice about this trade is, instead of having your break even at $363 a share, now it's down to about $356 a share. Okay, that's the advantage of a bull call spread. All right, now the downside is it doesn't still give you the probability of something like a diagonal trade, but it's still a very good basic trade. Instead of, and I will tell you this, as a newer debit spread or an option buyer, I would rather see you guys do this trade over simply buying a call, because it's going to boost your chances of success, it's going to cost you less money, and it's going to be easier. Okay, now you can do this trade when you think a stock is bullish or you think a stock is bearish. All I have to do essentially is just reverse. Instead of buying a $350 call, maybe I will buy a $350 put. All right, and I'd probably go a little bit lower just to get that in the money, maybe like a 355. Okay, something a little bit more in the money. All right, and then I would do the same thing. I would go out there and I would sell I'm just going to go a little bit under the price, maybe a 345. And there you go. I've got the bear put spread. Now, the difference between the bull call and the bear put is simple. If the stock goes up, you're going to lose money here. If the stock goes down, you're going to make money here. Okay? Now, in the efficient option buyer program, I tell you exactly which deltas to buy and everything else. But I want you to look at this bear put spread, because we're going to use this bear put spread to hedge a portfolio. Now, here's how it works. The first thing that I'm going to do to hedge my portfolio is I'm going to determine where I want to hedge it to. Okay? Where I want to hedge it to. So, I can do this based on the S&P 500, or I can do this based on the SPY. It doesn't make a difference, the SPX or the SPY. So what I'm going to show you guys here is, I'm going to put in this risk graph assuming a $100,000 portfolio. Now, if you didn't know this, stocks have what's called a beta weighting. Okay? You can beta weight your stocks according to major market indexes like the S&P, whatever. Most stocks will trade right around the S&P. Some will be a little bit higher, some will be a little bit lower, but overall, most of your brokers will give you this information. I know Thinkorswim does, that's who I use. I can go into Thinkorswim and they will tell me that all 12 of my stock positions are beta weighted 1.1 to the S&P 500. What does that mean? That means if the S&P goes up 1 point, I will make $1.10 in my portfolio. If the S&P goes down $1, I will lose $1.10 in my portfolio. Most of your portfolios are probably beta weighted pretty close to what the S&P 500 does. Okay? So, if you have a $100,000 portfolio, all right, here's how this works. And I'm going to use more of a live risk graph for this. I want to show you guys how it looks right now currently. All right, what I've done, and this is as of today, the S&P is at 312, 3120 right now. So let's say the S&P goes up 10%. So basically another 300 points. The S&P goes from 3112 or 3120 to, let's say, 3420. If the S&P goes up to 3,400, your $100,000 portfolio is going to go up about 8.8%. Okay, you're going to make about 8.8% if it goes up to 3,400. I know that's not exactly 10%, but it's close. It goes up about 8%. Now, if you do nothing, and let's say the S&P sells back off to, I don't know, what was the low? Back to 226. So the S&P falls all the way back down to 226 or 2250. You are going to draw down your capital by about $28,000. All right? You're going to suffer a really, really big loss. So, what do most people do? How do you protect a portfolio? Well, here's how you do it. You typically buy a put. You can go out and just buy puts on the SPY. Now remember, what does a put do? If I went out there and bought a put, all right, if I just go out there and buy a put, I will make money if the S&P 500 goes down. Now I can do this on the SPY, I can do this on the SPX, it doesn't matter. All right, so what I can do is I can buy SPY puts and I can hedge this thing. All right, now here's how I do it. All right, I am going to do some very quick math. I'm sorry, I used the wrong slide here. What I'm going to do is I'm going to take my $100,000 in capital and I am going to divide that by the current value of the SPY. All right, that basically tells me how many shares I can use to simulate this position. Now, what I also can do, and I'm going to go forward a few slides here, is this. All right, I am going to take the current price of the SPY and multiply it by 100. Why would I do that? So let me go back to my risk graph. Okay. Now, right now, the SPY is $311.89. Multiply that by 100. Why do you do that? When you buy one put, it will control 100 shares. 100 shares is the equivalent of $31,189. One put on the SPY will protect $31,000 of stock. So if I were to go out and buy 3, and you can go out to July, you can go out to August, it doesn't matter, whatever you feel comfortable with. If I was to go out there and buy 3 at the money puts, this is what my portfolio would now look like. That trade is going to cost me $4,500, roughly. I'm going to buy 312 puts. It's going to cost me $1,500 for every put that I buy. Now, here's the cool thing. The cool thing is, if the market goes back down to its 2250 low, I'm only going to draw down my capital by about 6%. I'm now protected very, very well. Now, if you guys didn't know how to do that, the efficient option buyer covers this kind of stuff. But what I like to do, and there's been a lot of research in this. There's been a lot of research. Overinsurance is bad. Too often, many traders buy this insurance too much. I want you to think about this, okay? This insurance policy is costing me $4,500. That's 4.5% of my capital. If I bought this insurance 3 times a year, okay, it's basically going to cost me $15,000. That means that if the S&P doesn't go up 15%, I'm going to lose money. I'm spending 15% of my capital to buy insurance. You can't do that. This is where the power of VectorVest comes in, by the way. VectorVest with our market timing, telling you when to buy insurance and when not to. But another good thing that you can do is you can also do this as a spread. So what I'm going to do, I'm going to show you the power of using that bear put spread to hedge your portfolio. So I'm going to add another trade into this. I am going to add a bear put spread. Now, I'm going to do it in August. That gives me a lot of protection, right? It's only June 17th. I got protection now for 2 months. I'm going to do it at the current price, 312. I'm going to buy, hit the wrong button there. I'm going to buy 3 at the money puts. Still going to cost me, by the way, $4,500. But now what I'm going to do is I am going to sell 3 of the same expiration puts against it. Okay? Now, what my goal is, just so you guys know, and this is covered in the curriculum perfectly, I want to sell an option, and then I want to buy one that's about half the price of the one I want to buy an option, and I want to sell one for about half the price. Okay? This is the perfect hedge right here. Now, here's what happens. This blue line And let me just remove some of this other stuff to make it easier on you guys. Okay? This blue line represents your portfolio without insurance. If the S&P falls to, let's say, 2780, your portfolio is going to drop by about 10%. 2780. Okay? That's a pretty good move. 2780 basically takes you back down to that low that we had in April. Right about there. Now, listen, if you wanted to buy insurance and you wanted to put your insurance farther out, you could certainly do that too. That's part of the curriculum. But what I like to call this is kind of like line in the sand trading. What I've done now is I've made a decision. If the S&P were to fall to 2780, it's time for me to weed the garden. I'm going to take a gain on this spread. Now, mind you, this insurance is only costing me $2,400. It's not a $4,600 insurance policy. It's only costing me $2,400. If the market sells off to 2780, your portfolio will drop by about 10%. But your insurance policy paid you 7.5%. You just cut your loss down by about 7.5%. Now, if the market were to go lower than that, you're still cutting it down a little bit, but at the end of the day, now you have your decision time. All right? What do I do? Do I want to stay in my capital? Do I want to exit some of my stocks? Do I want to do another insurance policy and give me some more room to make money? You are now protecting your capital down to about 2,800 on the S&P. All right? And again, it doesn't have to be 2,800. We can certainly do this at lower prices too. You know, I can go farther down. Okay? I can go much farther down. That trade right there, it's set up pretty close to being right. Now if the S&P falls to 2695, guess what? Now I've got a little bit more room. If that happens, my capital is going to draw down by about 13%, but my hedge is going to pay about 8.5%. I've reduced my loss by about 8.5%. Now, this trade is designed to do two things basically. Number one, it's designed to protect your portfolio. There's no profit target on this thing. It's basically designed to protect your portfolio. Okay? In a perfect world, this trade expires and you lose on it because let's say the S&P goes to 3,500. Well, your capital is going to increase by 12%. Your hedge is going to cost you only about 2%. So instead of making 12, you make like 10. All right? That is protecting your capital. That is the power of doing that type of trade. Okay? Now, if that looks complicated, if that looks confusing, well, everything can look kind of complicated and confusing the first time you see it. All right? This is why we put together a course for this. Because I don't want to see people get hurt like they did during that coronavirus sell-off. Yes, we at VectorVest had been calling for a market top. Yes, our students, if they did it right, were hedging their portfolios. But if you're not, this is definitely a trade that you need to learn. The price alone will pay for that portfolio protection. So, with that in mind, if this is something you're interested in, the big question that people ask is, how do I implement this into my investing model in the most efficient way? Keep using that word efficient. Efficiency to me is the most for the least. How do I make the most money with the least amount of risk? How do I make the most money with the least amount of time? It's all about efficiency. So I mentioned at the beginning, if you wanted help and an easy way to learn these concepts, I'd have a way to help you. And this is it. It's a course called the Efficient Option Buyer. It is a 6-module course. Now this course is a archived streaming course. So that means this: if you buy it, you can start doing it today. Okay? It's not like you're going to have to wait 6 weeks or do this over the course of 6 weeks. We release it all to you. It's a streaming course that was done. All the recordings are out there. You can do it right from today. I break it down into 6 modules. Module 1, I call that Operations Fundamentals. If you don't have any experience with options, this is going to teach you some of the options basics. What a call is, what a put is, what volatility is, things like delta and theta and all that kind of stuff. Things that you need to know to be an options trader. Then I'm going to go into that bull call and that bear put trade. Now, I showed you the bear put trade as a hedge in your portfolio. I will also show you that as a hedge for your stock positions. If you don't want to hedge a portfolio and maybe you've got like Netflix in your portfolio and it's coming up for earnings, I'll show you how to do a cheap earnings hedge on an individual stock. I will also show you how to use those trades for widely speculative moves that are very inexpensive. I will also show you how to use those two trades as a better trade than just simply buying a call or buying a put. Then in modules 4 and 5, I'm going to teach you those trades that I really like. That would be the synthetic covered call or the bull call diagonal for bullish markets and the bear put diagonal for bearish markets. You are going to learn strategies that work in bull and bear markets, because if you don't do that, it's going to be really hard to make money if the market sells off. Okay, that's a substitute for covered calls. I'm also going to teach you those earnings trades I showed you. And then finally in module 6, I'm going to put it all together and I'll show you how to kind of set up trades in a live format. Now again, that class is pre-recorded. It's all streaming. So if you do it, it gets released all at once and you can really just start getting right into that curriculum. Now, if the class is something you're interested in, VectorVest.com/EOB, it stands for the efficient option buyer. That is where you can go to sign it up. I'm sure that Brian's already put a link in the chat for you that you can just click on. And of course he did. Brian always beats me to the punch. Now, before I talk about price, I want to talk about a couple other things. Number one, I always want to start with my money back guarantee. If you take the course, you didn't think it was worth it, I will offer you a money back guarantee. Okay? I don't want you to feel like you've wasted money. So I always, with any of my options courses, I offer you a 100% money back guarantee. Because I don't want you going into this thinking, well, you know, Ron, I've done this before, it didn't help. Well, now you don't have to worry about that, because if you do it and it doesn't help you, you don't think, you have a refund policy. Now, most of you might know me. I always laugh when I say I always think of The Simpsons. This is Troy McClure, you may know me from. But another course that I teach is called the Options Paycheck. How is this different from the Options Paycheck? Well, let me explain. The Options Paycheck is an income-based approach. I believe that the efficient option buyer, when you do earnings trades and those diagonals like I showed you, those are also income approaches. This is a second tier or a second part of an income system. So when do you do paycheck? When do you do credit spreads? We do credit spreads when option premium is very expensive. That's when we do credit spreads. That's what we teach in the Options Paycheck. We do buying spreads like that diagonal trade when options are inexpensive, when they're cheap. So when you put both of those classes together, now you know what to do when premium is really high. You do your paycheck credit spreads. And now you're going to know what to do when premium is really low. You do your diagonal or your earnings spreads. Now you have a way to generate income really in any type of market condition. Okay, so it's kind of like the second phase, if you will, of the Options Paycheck. Now, also, if the class is something that you do, we will offer you live mastery support sessions. Those are going to be in July. Okay, July, and Brian will confirm the dates. I don't want to give you the wrong dates. So when Brian comes in here for my Q&A session, he'll give you the right dates. I don't want to give you the wrong ones. I forgot to write them down. The mastery support sessions, again, they're live. You're going to be in the room with me, kind of in a GoToWebinar format like we're doing right now. It's going to help you implement this, guide you, answer any questions you might have. Most importantly, demonstrate using live data. Okay? So again, if it's something that you're interested in, VectorVest.com/EOB. Now, last but not least is the price. The class is normally priced at $9.95, but we have a special buy it now price because you came to the webinar today with us. It is $7.95. So we'll knock $200 off the price. It is $795 if you register before the end of the class. We're going to still do a Q&A session. We'll probably be with you for another 10, 15 minutes or so, or however the questions dry up. You have the opportunity at $795. Now, if you are what we call a VectorVest Elite member, this course is actually $497.50 for you folks. Because remember, if you're an elite price, you get 50% off the regular price, so you get even a bigger discount. Now, if you go to that website, here's what it looks like right here, the Efficient Option Buyer. All you do is you click Purchase Course Now. It'll load the next page. You proceed to checkout. Now, here's the difference. If you are already a VectorVest member, you can hit this little sign-in button. Now, when you sign in, it'll have your VectorVest information in there for you and all that kind of stuff. Now, another cool thing, by the way, when you sign in, if you are a VectorVest Elite, it will automatically charge you $497.50. So you don't have to call in, see if you're Elite. It'll just do that for you once you sign in. And if not, you just fill out your first name, last name, and all that kind of stuff, submit it, and we'll get you going. Okay? Then you'll get the link for the course, and then what you'll see, ultimately, when you have the course registered, I'll show you that here in just a second, you will see inside of our VectorVest University area, you will see, I'm a really good VectorVest customer. I do all of our courses. You will see the efficient options buyer. I click on continue, and then here's and again, you can do this right up front. I mean, there's the option fundamentals, there's the bull call, the bear put, the bull call diagonal, the bear call diagonal, here's the earnings discussion, here's the Q&A session. I also already have mastery sessions that I did off the last class that I taught. Okay, so while we're waiting for the mastery sessions in July, you can actually go in there and watch the mastery sessions that I did when I first taught the class. And then, of course, under resources, you can actually go ahead and download all of the slides and everything. So you can do that as well. That way you have a copy of the slides that I use. Now again, VectorVest.com/EOB, just click on purchase and it does everything pretty much for you once you put in all of your information. Okay? All right, what I'm going to do now is I'm going to bring in my colleague Brian, who's been sitting in the background answering questions. We'll kind of wrap up with any last minute, office stuff, and then we'll break into some questions if you guys have any.
Hey, Ron.
Hey.
All right. So I did put the link into the chat box. You asked me to verify a couple of dates for you. So I guess I will do that first. So those mastery dates would be, they are on Fridays, and the dates would be July 10th and July 17th. So those are the two live mastery dates for everybody. And those start at 11 a.m. And of course, Ron showed you that the recordings, if you can't make it, will be put inside of the digital course so that you can go watch it there. Ron also showed you when you go to VectorVest.com/EOB, I believe, Ron, the best thing to do is to sign in first, not click the purchase button and then sign in. I'm pretty sure that's the way to get if you're an Elite member, for it to drop down the price. So click if you have a username and password, sign in first, and that'd be great. Ron Wheeler, these trades that you showed, I think the people I can just judge from the people in your coaching group, there's a lot of excitement about these types of trades, because like you said, they kind of round out the arsenal, right? I mean, you got the one trade that you're doing when it's a perfect time to be selling, but these trades kind of fill in the blanks where there's going to be a great time to do these trades as well.
That's exactly right. I mean, this is kind of like it's exactly the way I would put it, is filling in the blanks. Now you have, between the paycheck and the efficient option buyer, if you've never did the paycheck before, it's not like you can't do this course. I mean, they're both standalone courses, but you'll have both spectrums, if you will. You'll know what to do when options are expensive, paycheck. You'll know what to do when options are cheap, efficient option buying.
All right, so you got a flathead screwdriver, you got a Phillips head screwdriver, you got a hammer, you got everything that you could possibly need to go at the market. Now, Ron, I see that some of the questions that are coming into the chat box, some people are actually familiar with a plugin module that we got here at VectorVest called Options Pro. I saw in the chat box earlier in the webinar, people were asking, how are you calculating volatility? So why don't we just kind of cover a few things here? I'll just kind of rapid fire some questions at you.
Okay.
First off, do you need kind of like special software to do these types of trades? Or
No.
can you do it with your broker?
No, you can do it with your broker. These are very, very easy, and I've designed the coursework, so, and that's the nice thing, by the way, about being an option buyer. It's a little bit more simple, actually. So, yes, any broker can pull this trade off. You'll be able to see exactly what you need as far as the volatility. And really, there's really no volatility that's really special about this, but you'll be able to see that information with your broker. You'll be able to get that. I talk about it a little bit in the curriculum itself. But yeah, there's nothing special or proprietary about this. You can do this with Thinkorswim and Schwab and Fidelity and Questrade and all that kind of stuff. So no, nothing proprietary that you need to pull this off. Any broker can do it.
All right. So we do have a plug-in module called Options Pro. It's not included with this course because, like Ron said, you're not going to need that. But now, Ron, if somebody's brand new and like has never seen VectorVest before, we're going to give them access to our base software called VectorVest. What is the benefit of that tool to kind of help out with what you do?
It's all about finding good stocks. Good stocks when the market is up, bad stocks when the market's down, and actually finding good market timing too. Knowing when you should be bullish, knowing when you should be bearish. So VectorVest is probably the most cost efficient, there's that word again, way of helping you find trades. Knowing what stocks to perform this on that are good performing stocks when the market's up, bad performing stocks when the market's down. That's really what VectorVest does. It's a very critical part, I like to think, of finding trades very, very quickly and easily.
And Ron, I was going through, we do surveys after courses and with our clients, and I was reading through them, a big batch of them this past week, and a lot of the feedback as far as what they love most about the things that we do is Ron's ability in his coaching session. So the benefit that you're getting with this course is not only seeing Ron do it, but those mastery sessions, Ron gets in there. I mean, he does it. It's not just theory. I saw it, some places will be like, oh, this is all theory. It might work. No, Ron teaches it and goes in there and he's showing you real life situations, real life trades. And in those mastery sessions, that you've gone like a few weeks of taking the course, and then you come to those sessions and you could ask questions and see what it's like to actually do these trades in real time. So some cool things. And like I was saying, in those surveys, Ron, I didn't share this with you yet because I was just going through it last week, but just Ron's passion to making sure that you know what you're doing, you're helped, that fully knowledgeable and upbeat and positive and funny. So you get all like kind of the full package. All right, so enough of swelling your head there, Ron. I will stop before I pump you up too much. So the other thing that Ron mentioned is that there is a deadline here. So this low price of $7.95 is good while we're live here, which is going to be probably for the next 2 minutes. Then it'll go up to $8.95, and that'll be good until Monday. I believe it's 5:00 Eastern time, and then registration will close on Tuesday. So you got to get in. Now the course will be available after that at full price, but you won't be able to get in and get the bonus mastery sessions, and the course would be $9.95. Okay. Let's see. So you already answered a couple of the other questions, Ron, like the difference between this and options paycheck. So that was awesome. And let's see. So I see a question in here. After you purchase the course, this is from Val, does the access to the course expire? So why don't we just say, Ron, how long do they have access to this material? You might be muted if you're talking. I cannot hear you.
Yep, I certainly was. I was taking a drink of coffee. I didn't think anybody wanted to hear that. You will get access to for the course for 1 year. So you'll be able to watch the videos for 1 year. Of course, you can download the slides and keep those forever, but you'll have 1 year access to it.
All right. And I see Cool Dip. He typed in a question over. He's watching you do this on the YouTube stream, and he just wanted to know how many days for the money back guarantee. And one of the things that I'll mention. I'll just let you answer there, Ron. What do you have to say about the money back guarantee?
Well, I mean, that's a good question, Brian, because we normally don't do these streaming seminars, so I'm gonna have to defer to your expertise on how long. But I guess the thing is if you're going into it thinking about money back, I don't know. Don't think about that. Think about the learning. Think about the process of it. It's there. I mean, we're not going to fight you on it. We're not going to argue with you on it. So I don't want you to think that you have to watch the class in like 3 days. But, there's going to be a limitation on there. But, Brian, I have to ask you on that one because I'm not sure how we work that for the streaming courses.
Well, you actually hit all the points that
okay.
I was thinking of too. Basically, you have until the end of the course. And I believe technically, even though it's a recorded course, he does have those sessions towards the end of July. So basically, like, you just go through the course, go through the mastery sessions, and let us know. We're not going to fight you over it, but I think Ron, you had an awesome point there of like if you go into the thing with a negative, I don't want to say negative attitude, but looking for reasons to cancel and reasons to get your money back, you're not going to give it your full effort. So what all we would ask, Phil-Dip, is give it your all. Go at it with like a positive attitude and like say to yourself, this is going to work. I'm going to make it work. I'm going to give it my all and let the chips fall where they may. Okay. Yeah. Steve just typed into the chat box saying, if you go to Las Vegas expecting to lose, you're going to lose. All right. Well, I think Las Vegas is also probably going to win no matter if you stay there long enough. But we get the idea of what you're saying, Steve. I appreciate the comment. Yeah, if you attack it with a negative attitude, you're probably going to get bad results.
Dr. DeLeo always called that what? Don't be a Pollyanna.
You got to be an optimist, right?
Got to be an optimist.
Oh wow! I just saw this come over. This also came through our YouTube feed from Brad. He says, "I've done Ron's classes, and I've always paid for the class with the knowledge and the trade ideas."
Oh, excellent!
So thank you for sharing that, Brad. All right, so Deepak, you're not going to. We don't give access to Options Pro during this course, because like Ron said, he'll show you how to do these things with your broker and the tools in there. So with that, Ron, I'm going to actually pass it over to you to wrap things up, because I think those are the main questions that we saw. And I'll pass it over to you right now.
All right, sounds good. Thank you, Brian, as always, for chipping in there at the end there. Brian knows a lot more about the back office stuff than I do most of the times, and plus he's been kind of keeping the pulse on the crowd. So thank you again, and thank all of you guys for joining me here for this last hour or so. I want to wish all of you the best of success. I hope that you become good, efficient option buyers through the course. I'll be here to, help you every step of the way. We'll have those mastery sessions in July to answer any questions you might have. But I want to wish all of you the best of success. Thanks again for sticking with me here for this hour, and hope to see you in July in our mastery sessions for the efficient option buyer. Good night, everybody.